months. Right. As Paul said, Sylvia, you also said describe the three different stages or the phases we are facing now. How do you think, where are we now? First,
well,
second?
I think we're in the very first stage still. You're still seeing a lot of, you saw a lot of volatility in the liquid markets. You're going to start to see CLO selling. None of that has really happened yet. I think we're in the very, very first stage. I think we'll start to see some rescue finance, but there's been some deals that have already been done, probably at less than attractive prices. So on the margin, I don't think we've reset where we need to be in terms of risk, pricing the risk that's really here. So I think the real cycle is going to be starting, now, in the next, few months, and a lot of that is dependent on what happens. So I think we all agree that we're not going back to work on May 1st. Things aren't returning. You won't be visiting New York City anytime this year, I'm pretty sure, unfortunately.
I see. Okay, what about the real estate and real asset side? I know you are covering that area as well. The infrastructure and all those. So
this is a newer area for me, just in full transparency. But obviously, I think infrastructure is going to be a huge area of opportunity. The move from public to private assets will probably accelerate. There are certain types of assets, obviously, that will be questionable. Airports, big problem, right? Because airport assets have gone up a lot, obviously, but now airports are volume driven. About 50-50 is retail. I never thought about that, but actually it's not just the planes, it's also what you do at the airport in terms of retail, buying things, going to restaurants, etc. So all that is obviously gone and disappeared. But on the flip side, and also anything in transportation is questionable with ports, etc. But obviously communication assets, those are going to do very well, right? So anything related to communication assets, whether it's fiber optics, towers, things like that, are obviously going to be in very good shape. So it's really going to be a tale of two cities. And then I think there is the $1 million question is what's going to happen with energy. And there is a view that you might be an opportunity to buy some midstream assets at attractive values.
I see. By the way, Mr. So and Mr. Chang Dong-han, you can interrupt to ask any questions during our webinar.
Okay.
Do you have any questions to Sylvia and Paul so far?
I got a question for Sylvia.
Yes.
My name is Dong-hon Jang from POBA, one of the Korean public pension. Thank you for your kind explanation about the recent market background. So you briefly mentioned that there is a possibility that institutional money will flow from public market to private market. Trend will accelerate. Is that correct? You just briefly mentioned.
Well, I was mentioning that more in the context of just infrastructure, this idea of privatizing more assets. That's kind of like the more secular trend for infrastructure. But I think if you take it another way, because I've been talking to a lot of our CIOs of public pension plans, there had already been a move to go from liquid to illiquid assets in their investment programs, meaning that
rebalancing from liquid to illiquid.
Well, right, but I think they're not so worried so much about. I asked one CIO, I said, well, this denominator effect, meaning that obviously your public assets are marked to market, your private assets are not, meaning that your percentage of public to private is now going to be off kilter. They said, you know what, we were already going to be more illiquid. This just accelerated that path. And so I think unlike maybe 10 or 15 years ago where there was this desire to think that liquid was better, I think now people are starting to feel more comfortable with illiquidity and really thinking through, does liquid actually mean safer? And it doesn't always mean safer. In fact, a lot of times it doesn't. So really thinking through, what am I achieving by, quote, having liquid assets? What am I achieving by having illiquid assets? And really thinking about it that way. But the source of capital for all these new private credit allocations has almost always been coming from the liquid side, particularly liquid fixed income, and it's not coming from private equity. So I will foresee that there'll be more private real asset allocations, more private credit allocations and probably even more private equity allocations.
Yeah.
And that would be at the
also
expense of public markets.
Go ahead, Mr. Chang.
Okay, thank you for your detailed explanation. But I agree with your opinion, and basically for your reference, POBA, we invest heavily in private market. In our whole portfolio, at the end of last year, our alternative investment proportion is about 55% in our total AUM. So that means we are heavily dependent on the private market performance. So these days, what I'm thinking about is that as of now, I feel quite a lot of difficulties to deploying our capital in this kind of coronavirus situation. But as you mentioned, I don't know how long will it take. But what I'm saying is that if this kind of situation extended, POBA-like institution which heavily dependent on private market will have very difficulty to invest smoothly as we have been doing before. So, I mean, as a CIO, I think most of other CIO have pretty much similar psychology at these stages. Maybe we have already noticed that such a very turbulent market situation in public market. So, as a human being, we are trying to be more get away from that kind of market noise as much as we can. So we would like to be more focused on private market. However, this kind of a communication barrier and the due diligence barrier and deal sourcing barrier, a lot of hardships make us that we cannot deploy our capital. I start to worry about that situation. Yeah. So what do you think? That kind of a mega trend and upfront hardship we are facing at these stages.
Mr. Chang Dong-hwan,
Yes.
that's exactly my question to Mr. Brant Muller. He knows a lot of the state treasurers and CIOs of public pensions, and he has a lot of communications and informations from them. So after Sylvia, you can answer your opinion, and then Brant, you can introduce yourself and your view and other CIOs' view about Mr. Chang's question. How can we do from the deal sourcing to the exit smoothly in this kind of environment? So yeah, Sylvia, you can go first.
Yeah, I'll just say really quickly, I think one of the trends that we're seeing, for example, in private credit, it's almost like a chicken egg. If you think about direct lending, just to take one particular sector, what we've seen, and I'm sure that you've witnessed this if you've built out a private credit portfolio, is that the deals have gotten bigger and bigger. The size EBITDA companies that are accessing the private markets has grown. And what's happening is that now there are several, maybe a handful of very large global GPs that are doing what we call mega lending funds. So they're doing billion-dollar loans, huge loans that would have normally been done at the syndicated loan level. And so I guess what I'm saying is that as there are more capital that is okay to be illiquid, then I think you will see the opportunity set in privates grow bigger and bigger. And so as the appetite for private assets increases, there'll be more solutions that will be coming out of the private markets. And so I expect that we will continue to see that trend. It's not just in Asia, obviously, it's all over the world. So with that, I'll pass it over to Brant because he has really good perspective on
that. Thank you, Sam.
Okay, thank you. Yep. Brant?
Okay. Yeah, hi, I'm Brant Maller. I founded an investments think tank about 15 years ago called AIF Global. Focuses on private markets and the private markets part of institutional portfolios. At the time I founded it, I was on the investment committee of the U.S.'s second largest pension plan. And as noted, I really have chosen to spend my life talking to institutional investors and the folks who sit on their boards and the chief investment officers. So that's kind of the perspective I have. And I focus again on private markets, which primarily is private equity, private credit, real estate, infrastructure, and let's call it hedge funds from our point of view. And as noted, I'm on the board of the U.S. State Treasurer's Educational Foundation, and I chair their investments track. So I deal a lot with that perspective as well. A lot of the observations, I guess we can all sort of guess about this or think about it from our own perspective. Yesterday, we happened to have had a call. Sylvia, I don't know if you were on the call that we had with our boards, but some of the folks on that call were quite interesting. The chief investment officer for the state of Florida, which is the fourth biggest, I believe, pension plan in the U.S., and one of the Texas pension plan CIOs, who's also the head of the CIOs Association. And I'm thinking about a number of the comments that came out of that call, which may be of interest to folks. One of the questions, Sylvia, I was thinking about your comment about New York City not opening for business until 2021. TJ Carlson, Texas CIO, said, some of this is going to be a function of our tolerance for risk, right, and our willingness to change our behavior and live with a certain amount of risk out there in the world. I think sometimes in the U.S. maybe we have a lower tolerance for that than some other cultures do. As I sort of think to myself, people do business through wars and war zones, right? I mean, there's all sorts of ways to do business. And I remember after 9/11, what New York City was like, and I was a partner in big law firms then, and people were shocked that I was back in my office a couple of days later doing business as everybody else in New York seemed to be. I remember, after the global financial crisis, what happened to us there. Somehow we seem to bounce back from these things. So I guess I just don't know the answer on the human behavior part of things, how much risk people are willing to tolerate. One of the folks who participated in our call yesterday, one of the consultants, sort of categorized the issues in according to three different points. The first one being rebalancing, the second one being liquidity, and the third one being opportunities. And I guess that, to me, as I think about this from a higher level perspective, treasurer or on a board, CIO even, on the rebalancing side, I know there's a temptation in environments like this to rebalance tactically, but it's been my observation, again, these are all broad observations, that CIOs tend to be a pretty disciplined, patient bunch. And when I've seen even, Brexit got voted in or what have you, the general view of the CIOs I dealt with was, we're long-term investors. Right now, there's a period of volatility disruption. We haven't hit stasis yet. We'll wait it out and we'll see how the thing lands before we make any big decisions. So I heard a fair amount of that yesterday in our call. And I would say on the liquidity side, I remember 2008 vividly when we would sit in a conference room and CIOs would look at each other and say, who has a cash bucket, right? Because they suddenly became very worried about being too illiquid and being able to pay their bills. Just on the phone today with the CIO for one of the big state pension plans, who told me, actually an extremely underfunded pension plan, who said they had a 6% cash bucket. And a number of other CIOs telling me that they didn't necessarily see the coronavirus hitting, but they did see the end of a very protracted bull market in equities, and they were preparing for it in different ways. And I think by accumulating a bigger cash bucket, they were doing that. So to Sylvia's point, maybe the public pension plans are moving more in the direction that some of the endowments are moving away from, right? Of sort of saying, what's the amount of liquidity we need? And then the rest of our portfolio should be as illiquid as it can possibly be. This is one of our great advantages, is to capture the illiquidity premium. So I think that liquidity issue is out there, but again, the situation right now is so fluid, to Sylvia's point. I mean, we're so early in the process, there could be that double dip, et cetera, that I think what I'm seeing at least is that folks are being relatively patient. And I think the Florida CIO said to the extent that he's actually rebalancing, he's probably doing it through active management tools, probably taking advantage of more liquid shorter term strategies in the public markets. As far as opportunities, again, I think about our 5 core kind of asset classes, if you will: private equity, private credit, real estate, infrastructure, and hedge funds. On the private credit side, I regard Sylvia and Axia as being arguably the preeminent consultants in the world in what they do. So Sylvia's take on what's going on in private credit is worth a lot more than mine. My take on private credit, Sylvia, was that, and with all due respect to the hedge fund fellow on the call, hedge funds in the space I operate in sort of fell out of favor a bit a few years back, and in the big public pension plan space. And I think to the extent that people wanted to be more defensive, they tended to move more higher up the capital structure. So private credit, in some respects, I felt to me like it was replacing what some of the hedge funds were doing in their portfolios. I think that private equity, by some accounts, I think one of the fellows on the call yesterday said there was up to $2 trillion of dry powder in private equity and private equity and co-investments. It's a lot of money. To the extent that the folks that asset managers have dry powder, that's obviously a great thing. Vintage years, like the one we're going into, should be historically have proven to be pretty positive vintage years. I have been hearing a lot of noises about big draw requests coming from managers and a certain amount of concern that those managers are pulling down money a little bit fast right now, or that maybe some of them are in default in some of their subscription lines, and perhaps some of that money is heading places that they didn't intend for it to go. Sam, to answer your question, in an infrastructure, I agree with Sylvia. I think that infrastructure's lower returns, which were a bit of a turnoff when real estate was looking good, may end up looking a lot better, and the duration on infrastructure and the relative stability of it may make it more attractive. In the U.S., as you know, it's mostly been power and energy. It'll be interesting to see if it goes elsewhere. And I think the sector for me, Sam, to answer your question, that I worry about the most is real estate. I mean, anything that's dependent upon cash flows really makes me nervous. I mean, you look at, I thought that office for a long time was actually not showing the full effects of the internet because of the 10-year nature of leases in the U.S., for instance. You combine with that this notion of lack of ability to pay rent, and really questioning whether you want too many people in one setting together, and just the ability for people to work remotely. Again, I was a partner in big law firms, and a huge part of the cost of big law firms was what we paid to house our associates in a very fancy midtown office space in New York City. I'm not sure that once you see that they don't need to be there and they can work remotely, I don't know what that does to rents and the value margin of office buildings. Obviously, retail was a sector that was decimated. Hospitality is decimated. Industrial is going to have winners and losers. Obviously, telecom and logistics are going to be winners. Transportation, things like that, are going to be losers. And I suppose on the residential side, there's going to be this notion of essential versus non-essential. The essential will be the winners. So to me, I think that the diversification provided by the private markets and the ability to capture alpha by arbitraging dislocations eventually should make private markets attractive. But the situation right now is so volatile. I just don't know the answer, and the POBA CIO on the call probably can tell better than I can how easy it's going to be to just sort of move to greater allocations to alternatives as opposed to having to deal with a denominator effect.
Thank you, Brant. Can we discuss a little bit more or a little bit further about the real estate market? We have different markets in the real estate. It's a huge. We have hotel and resorts and shopping malls and residentials, commercials, and also we have REITs market.
I left them out. Yes. That would be devastated. Yeah.
You meant the real estate would be one of the hotspot from this crisis.
I think so. Certainly, anything that's driven by income, right? I mean, we're going to go through a period of no income to a lot of businesses. Also, the part that we left out, which I should have alluded to, is to the extent that the governments fund pension plans, these governments are going to be very strapped, right? Their tax revenues are going to be way down. Anybody depending upon sales taxes revenues is going to be feeling it. So that's that, I would say. But then there'll be other real estate that'll be winners, right? Like telecom centers and things like that. So, but generally, I think real estate is going to be a sector that's going to feel it.
I see. All right. Thank you. Paul and Sylvia, do you have any comments on that? And what would be your pick?
I guess I'd just like to throw a question out to Brant and Sylvia and to the CIOs. When we talk about private equity and we talk about private credit, for the most part, my knowledge of this is that these are long-only type of strategies. And granted, I have a bias of sort of being agnostic as to market direction in terms of having a long bias and rather be hedged in my type of approach. But I would see that in this time, isn't it somewhat dangerous to move towards private equity when valuations, even on the private side, can be 50% less in 6 months or a year from now? I mean, isn't that a scenario that's possible or even likely?
Well, I'll take a quick stab at that. So first of all, sort of the philosophy, and one that we adhere to when you think about private equity portfolios, and I actually think it holds for private credit as well, is that market timing, because it is a long-only asset class, is usually does not work out well. So if you think about you're going to invest in a private equity fund, it has a 5-year investment period. So if you just shut down all private equity investments for the next year or two, you don't get into any of those funds, then eventually you'll end up having a big hole in vintage year. So one of the mantras of private equity and also private credit is spreading your allocations out over a number of vintages, so that you don't have all of you, to your point, all of your investments occurring at potentially inopportune times in the cycle. So that's one way to hedge what is a long-only asset class. So I think staying the course, generally speaking, on alternatives, whether it be private equity or private credit, makes sense. I have, though, in talking to real estate heads of real estate, so far started to hear that where they had in the past been more focused on equity, that they believe that they'll be more focused on debt in the next several years. So whether or not you're a private, whether or not you're a real estate investor, you may be shifting more to debt in sort of like the near future. And I think that has to do, to your point about the valuation side and people wanting to stay top of the capital structure, being in a safer part of what is a sort of an unknown valuation outcome. So, and I think that'll especially be the case in real estate. I would not want to be buying things in real estate right now on the equity side.
Sam, I would also add that our call yesterday, I've been hearing generally there's this notion that people want to be consistent. They don't necessarily want to double down on things like private equity, but they do want to be consistent. So I think that's, and private credit, I suppose, the same. So that's consistent with Sylvia's.
Consistency means you want to stay in a course.
Yeah.
Yes.
In other words, on the rebalancing, I haven't heard a lot of tactical rebalancing. These guys mostly are sticking with their, 10% to private equity, whatever, 10% to private credit. That's what it should be. Let's not overreact.
But if one institution has a certain rule for the rebalancing, like with the band, 2% plus minus 2%, should they follow that rule, existing rule, or should they change the rule? This is typical time period. This is market. Many people believe this market is not rational. So how do you think about that?
Well, I was just going to say, maybe I'll answer that. I mean, right now, how do you even know what you've only just gotten December marks. You don't have March 31st marks for your private assets. So your rebalancing is based on information that is incorrect. So you're trying to do the math with one set of data from 3 months ago, which is obviously completely out the window. And then you have current data on the public side. So you would run the risk of rebalancing, and then all of a sudden now you're under allocated because you've used the wrong the wrong asset price. So so that's one problem. And I think that what Mr. Dong-Hang Chung had mentioned from POBA is one that's actually really important, is this noise issue. The noise is real. And so I think that's one of the appeals for private credit and private equity. Not saying that those assets aren't volatile, but it takes out that noise from the trading side, and it allows investors, public pension plans, CIOs, to focus on the investments versus having to constantly, defend their investments to their board or their stakeholders. So I think, or even their own self, right? So I think there is something to be said with eliminating that noise. And that's another advantage. So it's not just the illiquidity premium, it's also that noise, but also, and then finally having that control over the assets. Brent, I don't know if you have a comment on that concept.
I was going to say also, I think I heard yesterday from several folks that they still had some room actually in their allocations as well. So they were they weren't as, the denominator effect problem didn't seem as pronounced for them. Plus also again, we're in such a period of volatility right now. It's hard to, to respond when things are bobbing up and down so much. So I didn't hear a lot of concern about denominator effect from the CIOs.
I see. I will have the meeting in the afternoon, this afternoon in Korea, the National Pension Service Investment Committee meeting. There is an issue within the NPS here. They have a target proportion of domestic equity. This year, the target proportion of domestic equity is about 15% out of total portfolio, 740 billion, 15%. And their allowed band for that 15% is plus minus 2%. That was fixed last 3 years, that rule. But since February and March, the volatility is such a huge such a huge volatility, and the market cap decreased a lot. The Kospi index dropped from 2,200 to like under 1,500. So in order to keep the target proportion of the domestic equity, they had to purchase a lot more domestic equity. On average, they purchased about 3 billion, more than 3 billion US dollar of domestic equity in March, and they will buy more in April. But some of those committee members, they don't want to increase their long position on domestic equity anymore because of the impact of the domestic market. So they are hesitating to keep the rule plus minus 2% at this time, or they may want to increase the bandwidth to the double, plus minus 4%. We don't know about the clear answer about that, how we can react on this kind of the volatility.
Sam, a trend in the US has been to do more delegation of discretion to investment staff. Is that something that Korea is thinking about to avoid some of those, very kind of artificial mandates, to let the staff make a decision, be more strategic?
Yes, we are talking about that. And there is investment committee members, and there is inside the staff members. There is researchers under the NPS. So 3 of these different units are talking about the different issues. And today we have to decide whether we change our bandwidth or not. We follow the band. Mr. Jang Dong-han?
Yes.
Do you have any comments on that? Do you have any similar situation of rebalance?
Well,
in your portfolio?
Yeah, I can tell you about it, but I don't like to mention just for NPS. Well, I can share our POBA case and other global pension guys recent activities. I can share with you. Basically, as far as I know, in investment, I think strategic asset allocation is the most important mantra that the long-term public pension must have. But the reality is that in Korea, as I think Brent slightly mentioned, but I personally think that in Korean public pension society, corporate governance is not that sophisticated enough to make a more efficient decision making. So that means in every institution have some different environment. However, I think in Korean public pension, that kind of rebalancing is they are allowed internally. However, reality is that to execute that kind of rebalancing in such a very turbulent market situation, where it's really hard. I mean, investment staff must have, I think, authority and the responsibility to execute the rebalancing. However, reality is that there are lots of, I think, risk management to function and also corporate governance leadership make it difficult to make efficient decision making. So I personally think that, I don't mean to say that, the stock market is a really, good time to accumulate a position at these stages. However, I think that kind of a discretion should be given to investment staff to gradually rebalancing as much as they would like to have, stipulated by that strategic asset allocation with the framework, I think. And also, when I look at some global public pension, activities that these days, they didn't really, mention very specifically. However, I noticed that a lot of, European and the U.S. Public pensions are preparing to rebalancing, and also they did some gradually and step by step. Yeah.
Thank you for sharing your opinion.
So,
Mr. So,
I have one question about the operation risk, because as an investor of some private fund or hedge fund, now we are worrying about the increasing of operation risk in hedge fund or private fund, because I heard there are so many redemption from the investors. Also, we heard some fund they close or some default. So how about the default or operation risk in private market?
by the way, Mr. So, can you introduce what you are doing first?
Okay.
KIM
Because
and your function. What is your R&R?
Yes.
The KIM.
Yes, I am the oversight all the overseas investment in KIM. So I am covering over the investing hedge fund, private equities, properties, also other alternatives for the institutional investors in Korea, like POBA. So we are managing some the fund style fund in my companies. So we are worrying about our stock fund operation issues very much now. So Paul or Mueller, can you explain about the kind of default operation risk in private market?
Paul?
Repeat the question, Jade?
There is a...
So is there any operation or default risk increasing in the hedge fund market now?
I believe when you have this type of expansion of volatility, the type of risk always increases in this type of environment.
Do you see a lot of redemption in the market?
We haven't experienced
from the investors.
We haven't experienced or seen that amongst ourselves. But these types of events typically lead to reallocations. Either, as you're pointing out, some of them are forced. And most of the time, it's driven towards clients needing to raise liquidity. In the crisis event, there's a liquidity crunch, and cash becomes one of the assets that is at a premium. One of the things that was interesting to see in March was the gold market. Typically it's a safety asset, and lots of times in crisis events, while rates will go down and bonds will rally, you'll see there's a run to gold as well. We saw the opposite this time around, and I think that had to do with this raise of liquidity. So you do get redemptions, and you get people, investors raising cash during this
But
time.
I believe the number of redemption will be also depends on the strategy.
Yes, of course.
The market, there is a flaw between the strategy, money flow. from one strategy to the other.
Yeah.
Well, Professor Sam, I might just add, there is one particular risk that we are focused on, and it's called adjacency risk. So what do I mean by that? It's when you have hedge fund managers that run both illiquid and liquid, so private drawdown structures alongside a, typical hedge fund with quarterly redemption. And one of the things, and there's nothing wrong with that. And in fact, we like to see a manager match asset liability prudently, so that you're not doing these illiquid, semi-liquid, often distressed credit type investments in a vehicle that could suffer redemptions to the point that was just made. But what we do think about is, okay, well, what about business risk though? What if you invest in a 5-year lockout vehicle, but then the manager suffers a whole bunch of redemptions and now they cannot sustain their business because their main flagship hedge fund has lost all its assets, and so but you're stuck in this law. So we really think about that and cautious and make sure that there is low likelihood that the manager could be vulnerable to that type of business risk, because you're in a locked up vehicle, you can't get out, but you still need them to be able to sustain a team that can manage your vehicle. I don't know, Brant, if you have maybe thoughts on that, given your experience on the hedge fund side.
Sorry, could you please repeat the question? I got dinged in the middle of it.
Well, I guess we were just talking about like what risks operationally might there be given all this volatility, and obviously just redemptions is one risk, but then I was just mentioning the adjacency risk issue where you have managers, which is actually quite common now on the credit side, where they have their typical flagship vehicle, which is doing liquid. Mostly liquid investing, and then they have quarterly redemptions, but then they've raised these vehicles that are their dislocation funds or in drawdown structure. And so the adjacency risk meaning that with a whole wave of redemptions, maybe the assets get sucked out of the flagship, and then they can't sustain themselves anymore, but you're stuck holding the bag in the locked up vehicle, and now they don't have a team to manage it.
Actually, Paul, if you're still there, I was actually going to ask you. I mean, this would seem to be a time to take that in a slightly different direction. I guess we may be related. Hedge funds should be quite interesting right now, right? I mean, you've got volatility. There are a lot of folks, I guess, who are probably going to get caught basically just being long with fangs, and obviously that's not going to be, I assume, rewarded. But folks who are clever and look to arbitrage opportunities like you guys do, I assume. This is a good moment. I was honest before about the fact that I think that one of the selling points of hedge funds, liquidity, people still have a long memory from being gated in the global financial crisis. So I guess that still gnaws at some investors, even if it shouldn't. But again, if you can't afford to be